Alibaba reported their Q1 results last week. We'll jump into the numbers and the revenues over at Alibaba, take a look at it from a fundamental and valuation perspective, and as always, jump into the technical chart for this one and just discuss that one reason that's holding me back from buying this stock and making it a large position in my portfolio. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. We are on the road to hit 1,000 subscribers. Shares trading at roughly $93 per share. This is still a massive conglomerate of a company trading at roughly a $250 billion US market cap. Over the past year to date, shares have gone roughly nowhere, up just 1%. Over the past 1 year, stock is also flat, but over the past 5 years, it has performed poorly, down roughly 45%, and down substantially from its all-time highs back in October of 2020, where it was closer to $300 per share. Before jumping into the numbers over at Alibaba, I did want to talk about this story. Michael Burry exits his Alibaba and JD.com stakes in a portfolio overhaul. So Michael Burry of Scion Asset Management, the guy who made millions betting against the US housing market back in 07 and 08, has exited his stakes in Alibaba and JD.com, ditching them just months after doubling down on them. So this is a stark turnaround considering these two Chinese tech giants comprise roughly 20% of the firm's portfolio, and they were the top two equity holdings just at the end of March. Now, they did sell off Alibaba and JD.com, but along with that liquidated 15 other companies in a regulatory filing on Monday, which included much of the US banks. Now, certainly this can be seen as Michael Burry losing conviction in a stock like Alibaba, but I think in a broader sense, he is losing conviction on the US stock market in general, as the filing also shows that Burry opened long put positions equating to roughly 2 million shares in both the S&P 500 ETF, which is the spider, and 2 million put options in the QQQ ETF, which tracks the NASDAQ. And so certainly Burry selling off his stakes in Alibaba and JD and banks, but also betting large against the US economy and the global economy in general by opening these put positions. And if you don't know, a put is essentially just the bet that stocks or a certain stock will go down to a certain price by a certain date. And so it'll be interesting to see just how this plays out, as over the past few weeks, the market has been in absolutely rally mode. Moving on to the business highlights for Alibaba, they do report in both Chinese dollars and US dollars, which makes it a bit of a confusing sort of 10Q to walk through, but we'll do our best here and we'll take a look at just the US dollar amount for simplicity. Revenues coming in at $32.3 billion, which represent a 14% year-over-year increase on that top line. Income from operations coming in at $5.8 billion, an increase of 70% year-over-year. Now, excluding share-based compensation, that was up just, and I say just in parentheses, up 43% year-over-year. Net income coming in at $4.7 billion, and diluted EPS coming in at $2.40 per share. Now, whenever they say ADS, those are just American Depository Shares. The Alibaba you would buy on the New York Stock Exchange is not the actual company. They are just a holding company that holds these American Depository receipts for the actual Alibaba Group. And so EPS coming in at $2.40, that did beat expectations, which were closer to $2, so a sizable beat on that EPS side. And if you take a look at Alibaba's EPS history, they do tend to report a beat on that bottom line, and you see earnings are tending upwards, so you can expect positive things from Alibaba on that bottom line in general. Net cash provided by operating activities coming in at $6.2 billion for this most recent quarter. Free cash flow coming in at nearly $5.4 billion. That was a jump of roughly 76% compared to a year ago. Now, they did generate $5.4 billion in free cash flow, but used $3.1 billion worth of that in repurchasing common stock. So Alibaba betting heavily on themselves and repurchasing a ton of stock while the company stock is in a slide. Moving on to the business updates. Now, in the previous quarter, Alibaba had made the announcement that they are splitting up their business in sort of a reorganization, as they call it. And so they're breaking apart Alibaba Group into their 6 major business groups, which are Taobao and Tmall, the Alibaba International and Digital Commerce Group, which includes Alibaba.com, Local Services Group, Cainiao, Smart Logistics, their cloud segment, and digital media. So now out of these 6, I think the 3 most important that investors will be looking at will be Taobao, their digital e-commerce segment, which includes AliExpress and the Alibaba.com website, as well as their cloud group. Now, they do plan on IPOing some of these units down the road, and we'll see just how that goes through with regulators. But I do think this was a good move on Alibaba's part, as just splitting up the business creates shareholder value in general and sort of separates the management, and they can focus on pieces of the business more independently. Taking a look at their breakdown of revenue by segment. Now, in certain areas, their revenue by segment growth is very, very strong. We see customer management up 21% on that Taobao and Tmall group. We see international commerce retail was up 60% from a year ago, up to $2.3 billion in this 3 months ended. I do want to highlight the all-important cloud business over at Alibaba. They are generating roughly $3.5 billion of US revenue per quarter. However, that growth is very low compared to what we would like to see at just up 4% on a year-over-year basis. Now, certainly with this hype in generative AI, Alibaba's cloud business should be gaining market share and should be able to grow at a clip faster than 4%. And so I think investors in Alibaba would like to see this unit show stronger growth on that top line. Taking a look at the costs and expenses. Now, as an investor, this slide is what gets me the most excited, considering that their cost of revenues were down 2% year over year, down from 63% of revenue down to 61%. Even their product development costs were down 3%. Sales and marketing, they were able to keep flat. G&A, they were able to take down 1%. And overall, they were able to take down those costs 6%, which is why we saw those operating margins expand all the way up from 12% up to 18% in this most recent quarter. So certainly, as an investor, I do really like to see Alibaba controlling their costs very nicely, even though they were able to grow their top line by 14% and saw substantial growth on their bottom line. I also want to note their share-based compensation expense was roughly flat to down on a year-over-year basis. This is also very impressive to see, considering their share has done nothing but go down and stay relatively flat. We see their share-based compensation hasn't dramatically increased, which is what you often tend to see on stocks that see a big slide on their price. Moving on to the balance sheet over at Alibaba, their balance sheet looks absolutely pristine. They're sitting on total current assets of roughly $100 billion and a total assets of $245 billion. Now consider that this is a $244 billion market cap. They're sitting on roughly $245 billion of total assets. Now, that's not the entire picture. They do have liabilities at roughly $52 billion of current liabilities. So a current ratio of 2, which is great to see, and sitting on roughly $87 billion worth of total liabilities. But it's just incredible to see that their total assets is surpassing their market cap. That is just very, very rare to see in the public markets. Moving on to the technicals for Alibaba, this here is a 5-year time frame for the stock, and each candle shows 1 week of trading. Certainly since October 2020 down to April 2022, this stock was in a well-defined downtrend, trading in this downtrending channel. Since then, it has been on a long consolidation, sort of trading between this $80 all the way up to $120 area. And so Alibaba is one of those stocks that is on the more volatile side and can see large swings in its price both up and down. Over the past few months has been trapped in this channel. In terms of a level of support, I see a strong level of support roughly in this $82 range. You can move this down a little bit closer to 80 if you like, and Below this, I see a smaller level of support, roughly in this $60 to $70 range. However, I think this $80 support level is quite strong, as it's bounced off that level numerous times in the past few months. In terms of a level of resistance, I see a few. The first one being this $100 per share mark, certainly from a psychological perspective, that will prove to be resistance, but on a longer term, this $120 level has seemed to be resistance for a very long time for Alibaba, dating all the way back to May of last year. Now, overall, what are my thoughts on Alibaba? Certainly, I do think this is a very strong company on that fundamental perspective. They are growing their top line in that low double-digit range, and expectations for their growth on that bottom line are also in that low double-digit range. From a valuation perspective, this is certainly compelling, trading at a forward valuation of roughly 10 times forward price to earnings. They're doing a ton of stock buyback, and surprisingly, this reminds me of a company here in the US, which I am bullish on, which is PayPal. And I can find a lot of similarities between Alibaba's fundamentals and PayPal's fundamentals, as they're both seeing solid growth on that top line, strong growth on that bottom line, managing expenses, very cheap valuation. The stock has been in an absolute slide. There's a lot of negative sentiment around the stock. However, and this is a big however, Alibaba is a Chinese company, whereas PayPal is a US company. And so tomorrow, if you were to take Alibaba, place it in the US, give them US management, all of a sudden this stock should double, if not triple, as of tomorrow. But that's not the case. And so that's really the only reason why I will avoid Alibaba, is because the Chinese government is too powerful and too unpredictable, which brings a lot of uncertainty and risk towards Alibaba, as they can shut down the economy and really control how Alibaba dictates their business at any given time, and in an instant can change the fundamentals of this business. I think I'm not the only investor that feels that way. If you were to take a look at the Alibaba stock chart, certainly I think many of these investors have fled simply because of the high risk that investing in Chinese tech companies and Chinese companies in general brings to their overall portfolio. Certainly there's a lot of upside in a stock like Alibaba, but at any given instant, if this is a big position in your portfolio, it can absolutely and will absolutely blow it up. That was my take on Alibaba Group. Let me know what you guys think of this one in the comments below. As always, thanks so much for listening, and I'll see you guys in the next video.